So the great thing about these three gentlemen is they don't get paid for predictions. They get paid for making bets, right? So the rubber really hits the road with them. They have to look at the market and decide where does it make the most sense to put the money to get returns for their investors. So, you can hear economists on CNBC and they're wrong 90% of the time. These guys would be in a lot of trouble if they had that type of track record. So the focus of our conversation is not to discuss politics or to help Jerome Powell with the Fed and how to do his job. But, those are factors and there's things that we'll probably touch on as we discuss today. Obviously, he has that has a large impact on the economic outlook. In a couple of minutes, Tyson Halsey will be giving a quick, sort of set the table presentation for us with some charts and things just to sort of lay out where we are right now. It's be very quick in just about 5 minutes. My name is Mark Heil. I am part of the institutional team at Pacific Premier Trust. We work with RIAs and asset managers and broker dealers and so on down the line, investment bankers, helping people to get into the alternative world using their retirement dollars. They need a custodian. That's what we provide. And you heard me getting Chip a few minutes ago, but there is something I must do working for a trust company that's owned by a bank, and that is read a disclosure statement. And this disclosure not only applies to this panel, but all panels that follow today and tomorrow, right, Marty?
Absolutely.
There we go. Information presented is for educational purposes only and is not intended as and may not be relied upon as tax, legal, or investment advice. Pacific Premier Trust performs the duty as a custodian and as such does not evaluate, recommend, or endorse any particular investment opportunities. You are advised to consult your professional advisors for specific guidance regarding your investments. Investments are not FDIC insured, and they're subject to risk, including the loss of principal. And I'll just add on that, to the extent I offer any opinions as part of this discussion, they are my opinion and not those of the bank. So I'm not speaking for the bank. For the next 50 minutes or so, we're going to have a conversation up front here. And I invite everybody in the room who's live to join in that conversation. If you have a question, if you have a comment, feel free to interject. We can hear you pretty well through the sound system in the room that Marty's located in, so that really helps. But if we need to, Marty will repeat the question for you. So we enjoy doing it this way. We want you to be part of it. Feel free to jump in. The only consideration I'll ask is keep it short. We love comments and we love questions, but speeches, get a little long. So let's keep it to the point if you can. With that, I've kind of introduced myself and I give them very high level introductions of our speakers. What I'd like to do is, Jeffrey, is maybe have you just give a little background on yourself and your firm. Talk to us and just, in a minute or two, just give us a little background on you.
Sure. Yeah, I'm Chief Financial Officer at JWH Investment Partners. We're a family office, but we're also a consulting and research shop, and we publish a monthly report called Alpha Insights Review and Outlook, and a weekly report called Alpha Insights Weekly Playbook. We're probably best known for our study of technical analysis and interpretation of market charts, et cetera. But we offer an advisory service on individual equity trading, as well as very high level global macro analysis and asset allocation models. So that's the work that we do and we present. You can find us on OETV every Tuesday morning at 9 a.m. Eastern Time live. We do about a 40-minute segment there. And we publish a free monthly newsletter, affectionately known as Huge Insights, the big picture. And that will give you kind of some, delayed insights that, we've been talking with our institutional subscribers about for the previous month. We usually kind of consolidate the prior month's work into kind of a free monthly newsletter that we publish the following month. So something that you could take a look at. You can always find it on our website at jwhinvestment.com.
Fantastic. Thank you, Jeffrey. Tyson, you want to go next? Just talk a little bit about yourself and your experience in this field and what you're doing now.
Sure. My name's Tyson Halsey. I'm a money manager. I have my own firm. It's called Income Growth Advisors. I've been on Wall Street for almost 40 years, starting on the floor of the New York Futures Exchange and Merrill Lynch and Alex Brown. And then I went on my own. I've run a couple hedge funds, and I have some of the best and probably some of the worst returns you've ever seen. But I'm also 61 years old, and having learned, as Jesse Livermore said, I never learned anything in making money. It's only in losing that I've learned. I think I've got a lot of wisdom. I have had the pleasure of working with or meeting guys like John Paulson, Leon Cooperman, David Einhorn. While I was in New York, I'm down here in Charleston, South Carolina, and I'm ready to start unless I guess it's Cory who's going to start talking about himself.
Yeah, we'll have Cory speak and then we'll have you give the presentation. By the way,
Yeah.
Tyson is very modest about his success. So Cory, you want to step up and go next?
Sure. Cory Reeder, Chief Investment Officer with Omnia Capital Management. Originally from Australia, as you can probably tell. I'm not the one that has a weird accent. You all have those accents. And as you've already heard, I'm 7 feet tall, but that's the wonderful thing about Zoom, as I always say. It's the great equalizer because we're all 7 feet tall on here. So I've been 17 years in the industry, retired from basketball at the end of 2004. So I came in 2005 before the 2008 crash under a fund manager friend of mine who was a 25-year veteran. So, I cut my teeth under one of the best in the industry and learned, that specialty area. Stepped off from his team to start running my own funds. That was Smith Barney to Morgan Stanley, running my own funds there, and then left out in the middle of 2017 and have been out and independent since then. Effectively what we do, we are a very active, tactically managed model funds, run 11 different fund models. You got conservatives, moderate, aggressive, long, short, Bitcoin, Ethereum, cannabis, commodities, precious metals, a managed S&P, you name it. So we can go anywhere and everywhere for, depending on where the client's desires take them and where the comfort levels take them to. We are structured up as a third-party asset manager for other, for independent advisors and firms out there as well. So that's sort of the short and sweet of me.
Fantastic. Well, thank you, Cory. Tyson, with that, why don't you share your screen and take us through your presentation? We're all looking forward to it.
Okay, does everyone see IGA Income Growth Advisors?
Looks good.
All right, so this is a macro discussion, and I graduated from Duke in 1983 studying economics, which meant that I was graduating and studying economics at the time Paul Volcker was at the Fed, and we were seeing the back end of inflation. And frankly, at age 61, while I often feel still about 35, I actually realize that I've seen a lot. And in fact, when I talk to some of my older colleagues, many of us laugh because so many people on Wall Street simply have no perspective. In other words, they don't know what money markets were like in 1983, that they might actually yield 16 or 17 or 18%. Anyway, the purpose of what I wanted to do was just show a couple charts so people have a broader view of markets in general. And without any more ado, I said I'd do this in 5 minutes. And I'm going to time myself just to make it a little interesting. Forgive me. So, markets perspective through 7 charts. So, right now, the Fed is tightening interest rates, and Fed funds have risen to about 3.08, I think, and they're expected to end around 4%. But as I was saying, back here, 1980, you had, this shows, according to the St. Louis Fed database, about 18–19%, but they did actually trade up to 22% at the peak when Volcker was tightening to stop inflation after about 10 years of high inflationary rates. And I think not only is it important to understand they got that high, and I don't think they'll get that high, but I think normalized rates are a good bit higher. So when we're talking about 5 or 6%, really in a broader perspective, that isn't very high, but probably just as important. I think when you look from 2010 to 2022, interest rates have been essentially zero. And this has led, in my opinion, to bubbles in stocks, bonds, and real estate. And we're now unwinding that. And we're not going to get the wind at our back for a long time. A good example of how we're already seeing that manifest itself in the economy is in the mortgage markets. Mortgages often trade in relatively correlated to the 10-year US Treasury. And the 10-year Treasury, I think, is around 380, and that was up from 55 basis points. I'm getting ahead of myself. But the mortgage rate, I mean, I know I refinanced at around 3%. It was 670 about now. So in the course of the last year, essentially, what people can buy with mortgage money is now half, unless you have those strong cash flows, which people don't. Everyone's grown to really be very comfortable with borrowing cheap, and that has led to, I think, broadly asset bubbles all over the place. Now, the 10-year US Treasury, we have good history on, and what here you see this peaking in 1982, I think it was September, at about 15%. And it has gone straight down. We had all this accommodation, and it was rather furious. And again, we got down to 55 basis points, 0.5% in August of 2020. Now it's at 380, but where could it go? It certainly, I think that you could see much higher rates, especially given where inflation is. Now, what's driving all this, what the big issue is, suddenly we have inflation. Inflation has risen from practically nothing. I mean, for a long time, I studied economics, and for a long time, I kept on saying, wow, the Fed's so generous and all this easy money, we ought to get inflation. We never got it through for years and years. And then suddenly we got it, in part due to what they did in Jackson Hole 2 years ago, but COVID helped create supply chain issues. We have an energy crisis. And suddenly what we have is 40-year high inflation. The question is, how long will it be until inflation normalizes back to what is comfortable? We get some sort of normalization of interest rates, at least relative to what we're seeing. And I found this particular chart very interesting. Came from the transcript and basically what it said is they looked at all these different countries, Italy, Greece, yada, yada, yada. And once inflation exceeded 2% and went to 5%, it took on average 10 years for inflation to come back down. Now, all the doves are like, oh, things are going to get normal, interest rates will come down. But I can tell you 2 years ago, when the Fed changed their policy, they said, oh, we'll just have transitory inflation. So forgive me for being skeptical. And this is another reason to think this may be a long period of higher interest rates. Now, I think this is really fascinating because what is shown here is inflationary and deflationary cycles. So what's done in this chart is taking a look at the S&P and dividing it by the PPI or the log of the PPI. But bottom line is, if you go back 140 years since 1980, from 1887, you have periods that are deflationary and then periods that are inflationary. Deflation, and usually these periods run in the 10 to 15 year. I'm almost done, guys. Range. And again, my point is, I think that this inflationary cycle should not be underestimated and treated as easy to be resolved. And so we hope to see this come down. To give a little more perspective to markets in general, everyone knows Robert Shiller, the Nobel Prize winner, writer of Irrational Exuberance, Yale professor, and he developed a CAPE ratio. And basically, the CAPE got up to a peak valuation in 2000. Recently, it was at the second highest level, and now it is declining. And actually, it bottomed at the end of an inflationary period of the 70s, and also at the end of from 2000 to 2009. And so PEs arguably cannot just normalize to, let's say, 20% or 15%, they could go lower. And interest rates also, relative to history, I think could go higher. And one other way to look at valuations on the market in general is a Buffett indicator, where they take GDP and the aggregate market cap. I think that's the Russell 5000. And right now we are about 31% overvalued relative to normal values. And so 30% downside is possible. I think a lot depends on how inflation plays out, but I would be cautious. And I wanted to kind of lay out that kind of backdrop to let Mark lead this conversation. Any questions?
Fantastic job there, Tyson. Appreciate that. We'll give a minute for anybody that might have a question, and that includes our panelists as well. I'll
Just one
start
quick
it off.
question, Mark.
Sure.
If I can jump in, can you hear me?
Yes.
Perfect. Yeah, there was a mention of an ETF bubble, so you don't have to discuss it right now, but if you can discuss it at some point in time. I don't know if it's Gunlock or one of those guys says it's an ETF bubble, and it kind of falls in, alignment here with what Tyson's little diagram. Maybe ETFs are propping up the market a little bit. So.
Well, what happened is ETFs are basically exchange traded funds, which have made investing even simpler. You say, oh, I want energy, I want this, I want that. You don't have to think as much. So much money has gone in there. I think that it has really made investing very easy. And I think that after a period of extraordinary returns, you get these feedback loops where everyone is very heavily into ETFs. So I agree with Gunlock, and I'm smart to not disagree with him. But absolutely, I believe that there's a bubble in the equity markets and in ETFs. And ETFs have certainly exacerbated the bubble.
Hey, Cory, do you want to talk a little bit? Because I know you do a lot with ETFs in your modeling.
Well, and Mark, as you had referenced in some of our initial emails, that we had previously talked about the mother of all bubbles that I brought up last panel, and even back at the start of the year on that panel, which it's not just ETFs, it's stocks, it'd been bonds, it had been real estate. It was, look at the SPACs and IPOs and M&A and everything else under the sun that's going on out there has just blew out to egregious proportions. And to these charts and such, think about it as a rubber band. You got the return to the mean or return to the average, which means the more that you stretch the rubber band away from that long-term average, the harder that snapback is going to be, and the overshoot as well, which ultimately happens as in 2008 when things ultimately shot through to the other side of it. So there always comes a time to pay the piper, and so we now find ourselves in that arena where now we've got the devil to deal with everything that had gone before now. But as far as ETFs themselves, I mean, we use ETFs as the underlying investment vehicle within the fund models. So I do understand that there's been a big move away from mutual funds into ETFs. I mean, my whole career I've dealt with ETFs, and that was from when I came on with my friend 17 years ago in the industry. He had originally been a mutual fund trader, but then you had the whole Elliott Spitzer thing, market timing. He just ran a big book. He didn't do that stuff, but he adjusted over to ETFs just for the simplicity and the real-time trading and execution of trades and such. But there has been a move away from the active managed space from a cost-cutting perspective of investors. Why pay 1%, 2%, 3% in a mutual fund? Historically, I don't know where mutual fund internal expenses are these days, but when you can do an ETF for 0.15% just as a passive investment, then that's been very attractive. And then, of course, cost cutting across the whole spectrum. That was the whole Robin Hood model. Of course, they made their money on selling their order flows to Citadel, and but that then pushed it out across the industry for cost cutting to do zero cost trading across all the big brokerage firms as well. So, which I guess to that extent, that's been a deflationary impulse. So now we're going to see an adjustment back the other way with firms starting to charge for trades again as we move forward and deal with inflation. I don't know, but definitely there has been a massive exodus out of the active managed space into ETFs. And now, does that mean now all these passive traders? I always find that term interesting. People are passive traders. Well, the truth be told, when the pain gets great enough, those passive traders very quickly become very active traders as they sell out at any price once that pain gets too great to bear. So is that the end of this, the end result of what this ETF bubble that Gundlach's talking about? Is that the final pain point? So we'll see, I guess.
Yeah, and I remember in our last discussion that you also had another line that I thought was very interesting, which is cash is a viable position.
Oh, absolutely. Cash is a viable and a tactical position. And that's how, with the fund models that we run, we are, as I mentioned before, we're very tactical and very active in the management, and cash is a position. If we're in cash and we're avoiding a drawdown in any specific asset class or arena, then that's a good thing, right? I'd rather lose no money than continue to watch the value of the account decline and dissipate. So we use cash as a very large, well, an equal part to any other underlying investment position, and we're just trading in and out of those positions, try to capture the upside in moves in underlying investments, and then avoid the drawdown, so we can hopefully over the long term have a continual growth rather than this boom bust cycle that we are all very aware and cognizant of.
And Mark, can I just jump in here for one quick
Sure.
second? I just want to remark that there's a vast difference between the alternative fund space and active investment and the position of cash is viable, because most alternative funds will not go to cash, right? Because it's their opinion that they are active investors, so they must always be either going long or shorting, but not in cash. So anyway, continue.
Well, the other thing that's important for that, Marty, is they get measured on IRR basis, right? So if they take your cash, they call it, and they don't put it to work, then their IRR is going to be much lower. So they're going to get dinged when they go out for their next fund or when they try to recruit new investors for the current fund. So there's a lot of that plays into that as well. So they like to be cash just in time and cash out after the investment's over to make those IRRs look as good as possible. So absolutely, that's a different beast. And but I think cash, as you're thinking about the current situation and what we're in, if you're saying there's all these bubbles out there and they're all going to collapse and go down, how do you preserve your money and preserve your position? It's cash is a viable one, and that's what Cory has suggested here. Jeff, I wanted to pull you in, and we heard Tyson do a great job and talk about a number of different things historically. And myself, I remember the 2008 housing crisis, the 2000 tech bubble, the 92 savings and loan, the panic in 87 that was only a couple days, but it took a big dip and came right back up. And then of course you had 79 to 82, or late 70s into the early 80s, however you want to characterize that, with the high inflation and energy crisis we went through. And then of course, the 1930s Great Depression. If you were to compare what we're going through now or what you anticipate we're going through now, which one of those do you think is most, comparable to what we're dealing with?
Contrary to popular opinion, I would say it's the Great Depression for a number of reasons. I think one of the things that's missing from most people's analysis today is what degree of trend we are currently correcting. Where are we in the very long-term cycle? And by our analysis, we are correcting what I would describe as a super cycle degree advance that began in 1932 and terminated in January of 2022. That's a 90-year Gann cycle advance. And in our opinion, you cannot correct a 90-year advance of that magnitude in 9 months with a 25% price decline. It's our opinion that, there's an old saying, when in doubt, zoom out. Okay, we need to zoom out and take a look at this from a completely different perspective. We have epic bubbles in debt, okay, in derivatives. And let me just quantify some of these epic bubbles. Okay, we've got about $300 trillion in notional value of global debt, slightly more than that. If you look at derivatives, it's multiples of that. We have now exceeded a trillion, that's 1 quadrillion in total derivatives. Those are over-the-counter commitments, right? They're over-the-counter transactions that all have a counterparty. And if one of those counterparties fails, the entire system fails. Nobody knows. A lot of these swaps have been traded so many times, it's like a ball of yarn with 2 pieces coming out of either end. You don't know what's going on inside the ball of yarn, or where it's connected, or where the knots are tied, or where it's frayed. And I think a lot of people are staring at this situation in the UK and going, oh, well, you know, the Bank of England came in and they just raised rates, everything's fine. That is so far from the truth. Or don't worry about Credit Suisse. The regulators have already identified this. They're going to come in and swoop in and save the day. They can't, okay? They're not big enough to save the entire system. The balance sheet issues that exist in Europe are far broader than what has already been revealed at this point. I mean, there's an old saying, I think Warren Buffett is credited with it, but you never know who's swimming naked till the tide goes out. Well, you know, naked is the risk, right? And so we've seen some of these risks revealed. In the UK, it's in the DB system, which is only, I think, $1.5 trillion there. And if we think about the size of that, well, it was levered up at least 2 to 1, and there were, you know, a number of variant swaps that caused some margin call pain, and they were able to cover that. But if you multiply the DB system on a global basis, you're talking about something north of $30 trillion, okay? It's like the size of the stock market. And now you got to lever that up, okay? Unwinding that leverage is going to be it's going to be a task that's unimaginable at this point. The other thing is we've got a real problem with liquidity, okay? Liquidity is an inch deep and a mile wide, okay? I used to run a trading desk at Merrill Lynch back in the early 90s, a small equity desk in the Midwest. We didn't trade huge blocks of stock like our partners in New York, Chicago, and San Francisco did, but we would trade 250, 400,000, 750,000 shares of stock. And oftentimes we get big blocks of stock from, you know, Fortune 500 companies that were based in the Twin Cities that we knew. And we would go to those companies and, you know, Medtronic would buy 400,000 shares that some mutual fund wanted to sell, okay? Well, Medtronic and General Mills and, you know, 3M and Best Buy and all these companies that are buying back their stock, they've levered up to the hilt. They've borrowed as much as they could possibly borrow to buy back every share they possibly can. At some point, when we start to see the earnings crack, like we saw at Nike, like we just saw at CarMax, like we saw at FedEx, Apple, Microsoft, Intel, the list goes on and on. Eventually, these guys are going to have problems at the balance sheet level. They will not be able to lever up to buy their stock back at cheap prices where they should be buying it, not at elevated prices where they have been buying it. And that's when the liquidity dearth will just, I mean, you know, there will be a vacuum, okay, of liquidity where you come in to sell 100,000 IBM at, you know, 125 or whatever it's trading at. And the bid for that level will be 10% below the bid for 100 shares because there's just no buyer there. The company isn't stepping in and buying all the stock. Once that dries up, you won't see liquidity like we've been able to witness. The other thing is take a look at what's happening to volumes, okay? They have just been drying up, okay? There's nobody really trading except for retail here. Institutions have been selling out through using options to get out of their stock because they don't want to be seen, right? And so if I want to sell, you know, 100,000 shares, well, I'll just write a call and hope I get called away, right? I mean, that's the way it's being done because it's the only way to find the liquidity and get out at the right price.
Marty, the windows are locked in the building
do you
you're
guys
in,
have any
right?
data on this trading volume statistic?
Pardon me?
Do you have any data on the trading volume statistic?
Absolutely. Just take a look at the NYSE New York Stock Exchange listed volume. And I know a lot of the volumes, you know, going through dark pools, et cetera, but I mean, it's drying up, okay? Just turn on your machine and take a look.
You know, Jeff,
And again, to kind of make a statement, you know, Jeff isn't the first person to say bad recession, depression in the group. But I just want to, you know, put an overlay on that is that we're not talking about, you know, a dust bowl in Oklahoma, like John Steinbeck grapes of wrath, right? We've got the internet, we've got supply chain, so it's a
There's a
financial
30-year
issue.
depression in Japan. Okay, it's going to look just like that. It's going to be very quiet. It's going to be very subtle, and the value of assets will just collapse. Real estate, you know, private equity, public market equity. There just is no backstop to own it. Okay, the Fed's balance sheet's currently $8.8 trillion. Okay, they're trying to unwind it, and guess what? That's a headwind. Okay, that unwinding of liquidity is something that's just being ignored. We're all talking about rates, but the Fed is letting their balance sheet run off. Previously, they were buying $120 billion a month. Okay, now they're letting it run off at $95 billion a month. That's a $215 billion reversal from what they were doing. That's what's coming out of the market versus what was going into the market, on top of 300 basis points of hiking. And that's not over. I expect to see a 75 basis point hike on November 2nd, followed by another 50 to 75 basis points into 2023. The Fed has already said that their target is 4.5 to 4 3/4, and that's too low. Okay, to Tyson's earlier point regarding inflation, you've never seen inflation quashed until real rates exceed the core CPI. Well, core CPI is 6% right now. Okay, and if core CPI is 6%, that means Fed funds have to exceed it, or core CPI has to collapse to where Fed funds are. Which do you think is more likely?
So again, I'm not going to argue finance right now. Just hold on to Cory 1 second. So my only comment is that people aren't considering, so you know, again, I've talked about these cascading issues and contagion outside the United States, et cetera, but people also aren't considering that a lot of the assets that are depreciating in value right now are owned by the baby boomer generation who are going into retirement, and they're seeing huge loss in asset value, and they're going to want to sell these assets later as well, so they can live longer. Life is longer than ever for most people. So it's an intriguing period of time that we're in. And so let me turn it over to Cory.
Oh, no, I mean,
Can I just let me make one last comment, if you don't mind, and then I'll let you take it over. So, you know, the point is, when we get into illiquid assets, you have to extend your hold horizon. A lot of people who are buying private equity are expecting to get taken out in 10 years. I think that's 25 years now, maybe longer. And I could say something totally outrageous. You may never get out. You might have to look at this as it's a family business. We're in a partnership for the rest of our lives, generational partnerships that could last 100 years or longer. That's the way it used to be done. Talk to the Rothschilds, a 300-year-old banking clan. Okay, that's the way it used to work.
Cory?
And Jeff, no, I 100% agree with you. 1,000% agree with you. I mean, Marty and Mark will remember last two panels that we were on. I mentioned the dreaded D word of depression, but I've been saying it for a couple of years now, that ultimately when it hits, we could be looking at a 29 style crash and a 1930 style global depression. But you know, you want to talk about, you know, historical perspectives. You look at the debt to GDP of the global debt to GDP and where it was back then. They're on par. You look at everything that's coming down the road, but mirror over what, you know, you mentioned the great dust bowl of the 1930s. What's going on right now? Droughts and crop failures and problems, you know, above and beyond the actual supply chains themselves. Look at the droughts that are going on in food production areas, let alone, you know, the lack of access to fertilizer to fertilize said crops, even if they do have good climate. So there are so many parallels. When you mirror today with the 30s and map them over, you start to check all those boxes, and it's all, you know.
But today's droughts are really an outcome of poor government planning, right? So, but I think that Tyson had a comment in the last discussion. I don't know if that last month or maybe 2 months ago, where he said that maybe we're going to move away from a financially oriented global economy towards a commodities oriented, you know, manufacturing real things economy. Tyson, do you have any thoughts on that?
Absolutely. That's very consistent with the inflationary cycle theory I was purporting. And in fact, I actually have a quote, and I don't have it handy, but as Vladimir Putin was actually saying, to think that Putin would say something intelligent economically is not your normal go-to guy. but he said, this period of highly leveraged financial assets are going to be replaced by hard assets and energy. And, really, I think that's the cycle that we're looking at. And I think that's why it's really much more like the 1970s. And I want to take a polite disagreement with my two esteemed colleagues, Jeff and Cory, in that, and I'll just quickly point to this chart again. And I think that there's downside. I think that there's trouble. But if China goes into Taiwan, if we get into some sort of nuclear situation, I think the downside scenario that Jeff is saying is a much higher probability. But I think that they're going to try very hard not to create crashes, having gone through the experience of 2008, and how it plays out remains to be seen. And all I would say is that going into inflationary assets, going into energy, which actually are cheap companies, there are places to go. But I think that a lot of asset classes and assets are in trouble, and it's because people tend to invest with recency bias. Oh, well, that worked for the last 5 years, the last 10 years. You could even look at the 60-40 portfolio strategy and say, wow, that's just done great. But it's all backward looking. Right now we have rising inflation, and that's throwing a monkey wrench into the system. And so I think we're in a different environment. It doesn't have to be as bad as what Jeff Hughes has said, but I certainly agree that it could get that bad. I'm just hoping it won't.
Well,
And
Jeff made the point that he thought we're in a 90-year decline.
I would agree. I think you own a lot more cash and energy and uranium and diamonds, gold, and I think that you could do just fine. And that's all on the hard
So the
assets.
variable here is the human response, right? How
What is
are
that?
people going to respond? The variable is the human response, right? It's not just numbers. We're not all subject to finance. And, I think things are not dire for the United States. They're bad, but things are pretty dire for Europe, let's say, right? So there can be a political response to this, whatever economic environment we have. It depends on how well that's managed. And what we've seen, at least from a lot of management, they're not very good at government is not good at managing crises well. So,
But the positive thing is this: U.S. corporate balance sheets are not in bad shape, although yes, there are a lot of derivatives and there's a lot of debt, and they've added so much money into individuals through the whole COVID thing. There's still a lot of money there. Now that's getting spent and it's going away, but I would say there is still a small, not a good chance of a soft landing, but it's not disaster yet. But are we in precarious territory? Absolutely.
Hey, Jeff, you mentioned the CPI, and maybe you can enlighten people into just how many times the Federal Reserve has adjusted their calculations for said CPI over the history. As they move forward, they constantly take anything that is rising too much in price, they just sort of remove that from your computations. Real inflation is way above what the CPI core says.
Took the words right out of my mouth. I mean, if we're using the 1975 version of the CPI, inflation would be over 14% right now. I just want to correct one statement. I think it was Mark who said that I was looking for a 90-year decline. No, that's not what I'm looking for. I'm saying that we saw a 90-year advance, and a 90-year advance will be corrected in price and time over a multi-decade period, most likely south of 20 years. And so we do something that we call our economic cycle model. And Marty's seen this. It's a very long term. We've detrended 110 years of publicly traded market data for the Dow Jones Transportation Average. It's the most cyclical data series we could find. I tested this when I was at the Luthold Group for years, and we found that this was the gold standard in cyclicality of data when you detrend it, and it shows a perfect sine wave at 34 years, a Fibonacci number from low to low. And what we also found is that those lows tend to correspond with the end of wars. And so it's kind of a war cycle as well. And so one of the things that we noticed is that the cycle actually peaked this year. It was set to peak in June. It peaked in January, slightly early. Maybe we didn't peak. Maybe we're going to make another new high. We don't know. But we have broken below the long-term regression mean, which typically is not recovered until the next cycle begins. And so we expect that for the next 17 years, we're going to have a serious headwind from an economic perspective. And one of the things that if we look back over the last 17 years was clear is we had a tailwind of easy monetary policy, a very accommodative Fed. I think if Tyson's correct about inflation, what we're going to see is a much, much tighter Fed for much, much longer than most people believe. And in fact, I'm not a big devotee of Cathie Wood. In fact, I would say that almost everything she's ever said has been wrong, and that she just got lucky and was in the right place at the right time with having an irresponsible overweight in Tesla and Bitcoin in 2020. But that being said, she is a very astute economist, and she used to be my client when she was back at Alliance, and I worked at the Luthold Group. And so we would talk with her, and what I determined is that she understands economic cycles very well. And one thing she's been talking about that a lot of people just kind of brush aside is the risk long-term isn't inflation, it's deflation. And the reason I would agree with that statement is that the Fed will take every action in their power to quash inflation. And raising interest rates is the most deflationary action that they can take. And I do believe that longer term rates, the long end of the curve, has a high potentiality to exceed 6% in the next 18 to 24 months. And I think that will kill the housing industry. I mean, it's on, it's in the ICU right now, but it will be buried 6 feet under if the 10-year bond yield exceeds 6%. There's just no way that people can pay the prices that evolved from a low interest rate environment when we take mortgage rates and triple them, which is what effectively would happen at that point. My thinking at this point is that we could see the equity markets trade hard down. I'm talking S&P 500 2250 by March 2023. Then I think a bounce in the summer, and then another big leg down, which could take 10 years to completely unwind. And that could take the equity markets all the way down to sub 1,000 levels in S&P
Tyson
terms.
provided some
S&P
insight
is up today,
into,
right?
hold on, Marty.
Maybe we can do more of a short-term outlook, right, of what's going to happen. Because I mean, it seems like most traders are betting on a bounce, right?
Well, you got the
Fed will
bounce.
maintain it.
So
You got the bounce.
for short-term tactical, look, we got in heavy across all space because we'd been in cash and we'd been avoiding the downturn. So we got heavy into bonds and high yield and financial preferreds and stocks and commodities and precious metals. And that's been working out really good so far. But, it's a shorter term tactical play and we will move back to cash. I think longer term and part of what the purview of this panel is, like, where do people allocate assets moving forward? I think, Gundlach said that he's a buyer of treasuries at these levels. We move towards a recession or depression or worse, and that's always been a safe haven asset arena, so they could go up in price and be beneficial from here. I think the US dollar may have peaked and it could be turning down, so anything denominated in US dollars could benefit from that. I think I'm hugely bullish on precious metals, on commodities, and think about the food stocks and such that still, Bill Gates himself is buying up farmland. Cannabis, we go into a recession. Is cannabis going to become the new component of the Vice Index? It always does so well because younger people don't smoke cigarettes anymore. And it's been heavily overinvested in, and it's just been a downward dog for a long time. But, and then I think crypto itself, that's still out there and it's still viable. And I think as you get more institutional adoption of it, then, and it inflows, and then that could be a good arena. And stocks will be a buy, and there will be tactical opportunities. There are some massive bear market rallies that occur, but for a longer term bottom, I think Jeff's actually right on the money there. As far as if you're not going to be trading in and out tactically, then do you sort of sit it out for a while? And or look to other arenas away from stocks and bonds. So
So a lot of active management needs to be done moving forward until we work our way through this.
Our analysis suggests that the August 16th high was a primary wave 2 advance. And once that peaked, we are now in primary wave 3 down. And primary wave 3 may have subdivided. And so we believe that, we saw the first subdivision on September 6th, and we saw a 233 handle rally in the S&P 500. We then saw a decline into September 30th low, and now we've seen, I think almost a 200-point handle rally off that low. We count that as minor wave 1 or intermediate wave 1 and 2, and now minor wave 1, and this is minor wave 2 topping. We think the next decline will be a third of a third of a third wave decline, which will be the most powerful, the most wicked decline that you can imagine. We think we could find primary wave 3 low on or about October 25th to November 8th, which happens to be election day, and there's a Fed meeting in that window as well. But we're looking for an 87 style crash over the next 4 weeks, and we're dead serious about it.
Jeff, there was a question giving your statements. Where are you investing right now? Are you in cash?
90% cash. And when I say cash, I mean 1 to 3 year treasuries. The other 10% is available for tactical moves, and we're, long VIX futures, shorting equities into today. In fact, we bought some SARK at about $57 today, and we expect that to go to 100. So that's the inverse of the Cathie Wood fund. I would also tell you that I think a barbell strategy in treasuries might make sense, because as markets do crash, I think we'll see the inverse correlation between stocks and bonds kick back in, and money will be allocated out by big institutional allocators from equities as they're being pummeled into fixed income at the long end, because there's an asset liability mismatch and they need the cash flow long term. And so that could turn 10-year treasuries into a potential capital appreciation opportunity, right? When we get that trade on. So the barbell strategy might work, but for those who aren't nimble enough to trade like that, I would wait this thing out at the short end of the curve. And if I'm right about longer term rates going up eventually, say 24 months from now, north of 6%, then you'll get an opportunity to roll out the curve at much higher rates by being, safe, liquid, and focused on income at the short end today.
Mark, we got about 10 minutes.
No problem. As you can see, this has got a life of its own up here, so it's really terrific. One of the things Tyson was hitting on when he spoke a little bit earlier was the precious metals and commodities area, and I think Cory also touched on this. Where in that spectrum are you seeing and are you playing right now? And Jeff, if you have a counterbalance to this, where you say right now for the next, you were speaking about the next 30 days or 40 days out, is that still a viable bet to make?
So my answer is this: I think liquidity is going to be flushed out of the system, and anything that can be sold will be sold because it must be sold. And gold, precious metals, miners, those will get flushed with everything else. They'll have to.
Cory, you agree, or you?
Well, and that's true. I mean, that's what we've been seeing. Correlations go to 1. When markets sell, you see just a screen of red in every asset class out there. So
the impact on crypto then, because that's, one of the most liquid assets out there, and it's easy to.
Well, but crypto's already hit it. Sven Henrik, for anyone who follows him, he had a technical target on Bitcoin at 20,000, and it went down as far as 17.5, but it's been bouncing around and sitting right around that level. So there may be some out there that have already had most of the flush washed out of them. Could it go lower? Of course, it always could. If people are that liquidity strapped, and they're, you don't just throw the baby out with the bathwater, you throw the bathtub out as well, just to raise whatever funds you can. So anything's possible.
Our published
Tyson,
target is 12,500 on Bitcoin.
You're saying 12.5 for Bitcoin? Yeah, I
Yep.
think we had somebody at last month, Marty, was it, saying 7,500 was what they were projecting?
7,200, yeah, yeah.
7,200, yep. So it's not been unheard of. Tyson, want to pull you back in here a little bit. Where are you looking to put, you've heard the different pockets. You mentioned several things already. Are there areas that you're looking to put money into to help people make money during this downspin?
I'm going to disagree with Jeff, but I'm going to compliment him too. I actually called him a month ago to use one of his charts. And what that chart showed was that 60% of S&P earnings came out of one sector, that was energy. And virtually everything else in the S&P was not making money at all. Now, I don't have the numbers in front of me, but Liz Ann Saunders said something to the same effect just recently on TV. And I think that clearly you are coming out of a cyclical down cycle in energy. And right now, that's got the wind at its back. That's where I'd be putting money. Now, you can't put 100% of your money in there, but I definitely think you don't have the downside risk that you do in the assets that have had big moves. I'm also going to this is where I'm going to disagree with him. I think that gold will become a major leader, and actually gold, silver, I guess all those precious metal, the precious metal group, I guess they call it. Because if we're in an inflationary environment, gold historically has shown an ability to retain real value relative to inflation. And I think that that's going to be a place where people should be tucking money away. And I think that I'm going to bet on somebody who I believe is one of the greatest traders ever, has made $5 billion in the space. That's John Paulson. And he makes the interesting comment that goes somewhat to the liquidity argument. He said in 2008, all the financial accommodation went to repair a lot of bank balance sheets. Banks aren't in that bad shape. A lot of the accommodation that's occurred recently and through COVID has gone into individuals paying off debt and giving them bank accounts for a while, some of which they used to open accounts at Robinhood. But a lot of that's burned off and it's going down, but they're still not in bad shape. But Paulson said, and I believe, that you're going to find that gold is actually going to catch a life of its own. And I think that it will become something that people understand and has proven to be a very durable source of capital preservation. But by the fact that it really hasn't gone through a massive move, I think it really could do very well and surprise people. And I know that's controversial. And I'm going to throw it back to Cory. I mean, Cory, if you had to pick crypto or gold, which and why?
Well, I guess given that we run both a precious metals and a Bitcoin and an Ethereum fund, I guess we don't have to choose. We just offer the fund models for people to choose themselves. But look, even Goldman Sachs has a price target of 2,300. Gold's currently at 17. So even if people want to believe the big Wall Street banks, that's a big 35% jump right there just on gold. Miners themselves are heavily undervalued compared to the price of the metals themselves as well. Looking at the charts, it's not a perfect setup, but there is a big, what looks to be cup and handle pattern, which points to potential huge upside in gold. If now that rates are coming, well, yields, I should say, bonds are starting to turn and the dollar's coming off. That's taken some of the pressure. We're seeing huge moves in the precious metal space these last 2 days. But like I said earlier, I think the precious metal space is a huge opportunity moving forward. And you got to remember too, on geopolitics and the global scale, China and Russia have been massive gold buyers on their central bank balance sheets for years and years, and they've been offloading US treasuries at the same time. The US dollar will not be the world reserve currency forever. No currency ever has. And so why would the US dollar be any different? So, I mean, we'll see how that all plays out, but Russia's also set up their own gold trading, like the LMBA in London. So, there's a lot of things going on behind the scenes, and ultimately getting back to the debt construct out there, do countries start to push for a some sort of backing of all that debt at some point. Hence, people have to start to pony up gold reserves as as back support for the global construct of debt that's out there that is currently just all fiat currency. And what the US dollar is backed by the full faith in credit and $31 trillion of debt of the US government. And what else? I mean, we went off the gold standard back in 72, Nixon. So, there's all those factors that could come to play. Until they do, nothing's anything until it's something. So, but I think that overall that precious metals is a good place to be. Now, there could be shorter term, as Jeff said, when you correlations go to 1, it doesn't matter what you're in. When things start selling, everything starts selling. But longer term, I'm right there with you, Tyson.
So Tyson hit on energy, and
Mark,
I know
we have time
Marty's
for one question. Any questions here from the audience? Any thoughts? Okay, time for you want to? We got to wrap up. You hear me, Mark?
I can hear you. Okay, then let me finish
Yeah.
out the question then. So Tyson mentioned energy, but energy is not a monolith. It's not all the same. There are different areas of energy. So, oil and gas has been down. You could say it's at lows. Green energy has been a favored nation for a long time due to ESG policies, things of that nature. What do you see happening in energy?
That's to me, I would say, I think MLPs, master limited partnerships, those are the pipelines, that's the toll road business models. Right now, the current administration will not allow anyone to build anything new, and we need it. And by virtue, those assets actually become very scarce. You get a great yield right now. And interestingly, MLPs tend to correlate with the price of oil. And I think the price of oil has a chance of going up. And if you want an inflation hedge and you want good income, I think MLPs make sense. But I also like natural gas and LNG and maybe own a little uranium, because I think nuclear is going to be an important transition fuel over the next few years.
Terrific. Jeffrey or Cory, anything to add to that?
Isn't that funny with all the clean energy proponents out there, and nuclear of all things is actually one of the top ideas in the clean energy space is. It's just funny how things, what goes around comes around.
They like their lights
Uranium.
on.
Uranium would be my top pick in commodities.
Yeah, and we have uranium and uranium miners in our commodity fund. So yeah, totally agree with you in that arena.
Well,
Great
guys,
job, Mark.
I want to thank you for this, and Marty, thank you.